Hello and welcome to the Ask About Wealth podcast. As regular listeners know, sometimes I'm here by myself, sometimes I'm joined by a guest, and when I'm joined by a guest, we tend to take guests from two walks of life. We interview entrepreneurs to tell us about their experience and help perhaps would-be entrepreneurs or other entrepreneurs out there to avoid the errors that they may have made, or indeed to learn from the positive examples they might have. The second type of person we bring is somebody from the financial world. And today I'm delighted to welcome Philip O'Connor, who's MD of CA Partners, specialists in capital allowances. Philip, thanks for coming along today.
Thanks, Paul. Nice to be here.
I suppose the easiest thing, Philip, to start off with is tell us what you do.
So I'm a capital allowances specialist. By background, I'm a chartered surveyor and I'm a tax advisor as well. So two worlds coming together there, property and tax. And what we do is we help people claim additional tax relief for money they spend on their investment property and business property. So we analyse construction projects like property developments, fit-outs, refurbishments, and property purchases, and we help people claim tax relief that they don't realise that they're entitled to.
Okay, well, this is right up our street, so I'm particularly happy you're here today. But tell me, when you say people, what type of people are we talking about here?
So it can be any taxpayer, really, an individual, partnership, corporate, who have spent money on property, and that could be a business property or a rental property.
Right. And I know you focus on property, and we will focus on property predominantly here today, which of course is the biggest single investment asset at use in the Irish world from an investment perspective. But there are other types of capital allowances, aren't there? Can you just broadly tell us what the various types of capital allowances that are available?
Yeah, so this is a scheme of tax reliefs that's available for investment in certain items. So it's not just property, that's our main focus, but as you rightly said, it also applies to other assets like cars, machinery like computers, appliances, furniture, and a whole host of different items, really. Our focus then is on the items that are claimed less often, that are not as obvious, but they're valuable. So it's really what it is. It's the government giving you a tax write-off for items that depreciate over time, that reduce in value over time, but that are capital
so wear
assets.
And tear allowances, I think
That's
I read
why they're
earlier.
called wear and tear allowances. It's effectively, the way you've accounting depreciation, it's tax depreciation. So you're not allowed to write off anything for the cost of the depreciation of an asset unless it's qualifying for capital allowances. So,
okay. So, and broadly speaking, I mean, I suppose the most familiar write-off for those listening will be the 12.5% over 8 years write-off, which applies to quite a number of the items you listed there, I think. And I suppose would also be regularly picked up by the for want of a better phrase, normal accountant. But you, as you say, you specialise in property. So we'll focus on that for now. And so what are the rates of write-off in your specialist area?
So it's usually those wear and tear allowances, which are available at 12.5% per annum over 8 years. So, for example, if you identify 100,000 of capital allowances, then you get to write that off at 12,500 per annum over the 8 years until it's all written off. Basically, it's a deduction from your profits, like having an expense, except with an expense you write it off in 1 year. With this capital allowance, you have to divide it by 8 and write it off over 8 years. The idea being that an expense is something that's a cost that's exhausted straight away, like we'll say your electricity bill. But a capital asset is something that endures over a period of time. But so, yeah, it's over 8 years typically. And then there's other types of reliefs as well. There's also industrial building allowances. You get that over 25 years at 4% per annum, because the thought process being that depreciates at a slower rate. And then there's other types of capital allowances, like they're area-based incentives. So there's this scheme called the Living City Initiative, and that's available for investment in property within specific
urban
zones
areas
within cities. Yeah, all the main cities qualify. So the benefit with that scheme is, unlike what we look at, where it's only specific assets that qualify, if you qualify for the Living City Initiative, if your property's in a specific location and you're spending money refurbishing it, then you could be entitled to write off the entire cost of your refurbishment renovation. And
over how long in that one?
You get that one over 7 years. So it's
slightly accelerated from the normal 8 years.
But the difference being that you get to write off the entire cost, whereas usually the buildings we're looking at, we have to analyse property spend in detail, and it's only a small proportion of it that you can claim after our analysis. But with this one, you don't need a specialist to get involved, because everything that you spend qualifies.
Because it's a specific piece of legislation on this in an urban renewal or environment.
There's an application process whereby you just make sure you qualify in the first case, you apply to the council, and if you're successful, then it's a matter of logging your costs properly, making sure you satisfy the conditions. And then at the end of it, all your spend qualifies. There are limits that apply, so it's up to a certain limit of tax relief.
Right. So to put kind of numbers around what you're saying there, and I'll take your 100 grand and the 12.5% write-off, for example. So if I'm an individual and I'm getting those write-offs, effectively I'm paying tax on 12,500 a year less than I would be if I didn't have this write-off. So my benefit is 40% of 12,500, which in that case about 5 grand, I think, off the top of my head. So 5 grand a year I'm getting over 8 years. So the benefit is €40,000 in less tax paid. Now, if I write it off at 4%, you can do the arithmetic. If I write it off at over 7 years, what would it be? 15% a year then, would it? And 10% in last year?
Exactly.
Okay. So my brain is working on the arithmetic side. Is it your experience, Philip, that people who are entitled to this type of, especially the area, I'll come now focus in on your area, which is predominantly property. Is it your experience that people have a right to claim allowances but are not?
Yeah, so this is a specifically legislated for area, so the government wants people to claim this relief. It's there for the production and value of these items over time, so people should be claiming it, and they're entitled to claim it. I sometimes get asked, like, is this some sort of loophole? And loopholes are illegal. This is written into legislation specifically to enable people to claim this tax relief, but it's complicated, and it requires a skill set that's a bit different to your normal advisor. So these claims tend to get missed a fair bit. Right.
So I mean, we've said here before, and the Revenue regularly report to the PAC about the overpayment of taxation in Ireland. I mean, the last figure I think we heard was 400 million. That Irish taxpayers leave 400 million a year behind them that they could claim. And it sounds to me that certainly a major contributor to that number has to be in your space, in the sense that these allowances are available, but as you say, not necessarily known by the kind of standard financial advice that people are getting. Would you agree with that?
Yeah, look, I'd be surprised if it was even within those figures, really, because it's an unknown, really. It's
Right.
not something the government would be able to put a figure on.
So
in
the
terms
figure
of
is
those
likely
figures.
more than 400 million.
I'd be surprised if it wasn't.
Right, very good.
Far in excess of that.
For those who have missed the boat, as it were, because they just didn't know, is there any way of looking backwards and saying, oh, I should have done this? Because I imagine we will have listeners who are thinking, oh my goodness, could I have claimed something and missed the boat? But there is some way of looking backwards, isn't there?
Yeah, so these capital allowances, they have to be claimed within the relevant period. And what that means is the time when you spend the money or when it becomes used for the qualifying purpose, that's the year you have to first claim it. So let's say if it was in 2024, that tax year you'll be filing that tax return for 2024 shortly, in October if you're an individual, September if you're a company. So you've got that time lag, number one. And number two.
So as long as the year is open, you still can look backwards in
Yes.
that sense. Okay.
And then on top of that, if we'll say you missed the boat and there was a claim that could have been made and should have been made back in 2023 or 2022, you're entitled to go back and amend that return. You still have to go back and claim within the relevant year, which would be 22 or 23. But you're entitled as a taxpayer to go back up to 4 years to amend previous tax returns. So you can go back, claim your tax relief that you should have claimed at the time. And what happens then is you're effectively saying to Revenue,
I overpaid taxation.
I've overpaid tax. Can I have the tax I overpaid back, please? And they'll give you a refund. So that's how that works.
And I suppose that'll be a credit against your next tax bill, rather, or do they send you a cheque?
Well, I suppose these days it's not so much checks
telegraphic
as a bank transfer, but yeah, like a lot of our clients have received funds back, cash funds back in terms of transfer back for claiming capital allowances.
Let me interrupt this podcast for a moment. Do you know how to create wealth? Do you know how to limit your taxation? Do you know how to protect that wealth when you do create it? Well, if the answer is no, our masterclass is for you. Over 12 modules and 36 videos, I will personally teach you how to create wealth, how to minimise your taxations, how to protect that wealth when you create it. Check out the link below, and now back to the podcast. So in terms of the clients you represent now, would you have an idea of what percentage are people who missed the boat but were looking backwards as opposed to those who are planning forwards?
Most of our clients really are people who have missed the boat. So I'd say about 60% of our clients are people who maybe didn't realise they could have claimed on money they spent a couple of years ago at least, and they're going back and they're amending and claiming this relief.
Fantastic. So if you've missed the boat, it may not be too late. Certainly if you've missed it by 4 years. There's nothing you can do going back even further than 4 years, is there?
You can, but for every year you go back, you lose a portion of your claim. So the value erodes away. So if you're talking big money, then it might be worth going back further. But if it's small money, then
it may
value
not be
erodes
worth
away,
it.
and then you'd be having to amend numerous tax returns. And some people don't like doing that. So.
Okay. So before we started the tape rolling, as it were, you and I had a conversation, and you were telling me some of the items in a property purchase that might be available or could attract capital allowances. Can you tell us a bit more about that? What in a building purchase are you looking at, and what are people not claiming allowances on that they should be claiming allowances on?
Yeah, and I suppose just to take a step back about the concept here, it's predominantly we look at property purchases and then other capital projects like developments and fit-outs and refurbishments. Within those large capital outlays on property, there's a significant amount of tax relief that can be claimed but that isn't claimed. And we use our expertise to dig into the detail behind that spend and help people claim tax reliefs that they are entitled to and should be claiming, but they're not able to do so through traditional advice. So for a property purchase, if you buy a property, we'll say, use a simple example of a rental property that costs 500,000, then within that property, if it's a fully fitted property in good condition and you're planning to let it straight away as a landlord, we'll say, you are entitled to claim capital allowances on some of the installations in that property. So the items you're allowed to claim on are called plant and machinery, and that's defined.
Even, sorry to cut across you, but even though you've bought them, but as part of the overall property deal, as it were, rather than bought a shell and then put a cooker in it and put a sofa in it and stuff like that.
So putting the sofa and the cooker in, you can claim that, but that's after the purchase.
Yes.
So I'm talking about the installations attached to the fabric of the building that are there when you buy the building, that are part of the building. So these items they're called plant and machinery, and that depends on the type of, what qualifies depends on the type of property and how they're used in the course of the trade. It's defined by case law as to what qualifies. So I can't give you a list because it's case dependent on the type of building. But let's say, for example, the heating system in a building, that can qualify for capital allowances. Every apartment will have a heating system, and there are numerous other items as well. And the legislation entitles you to claim capital allowances, attributing a portion of the money you spent buying the building to that heating system and other items.
And is part of what you do putting a value on that heating system, as it were, so that you can identify what is offsettable?
Correct. So we, on a property purchase, we look at the property purchase and what are you buying? You're buying, if you buy a house, you're buying the land the building sits on, you're buying the bricks and mortar, the structure of the building, and then you're also buying these items that qualify for tax relief, these capital allowable items. And we value all of those elements. We value the land, the building, and those plant and machinery elements. And we prepare a professional valuation using expertise as chartered surveyors, and then using our tax knowledge to identify the qualifying items that you can write off against tax. And that's the substantiation that you need then to claim to be tax compliant, because Revenue don't give this relief away for nothing. They want you to be able to prove it's a prove it or lose it situation. So you need to be able to back up your claim to be compliant.
So when a client hires you and they get this kind of price breakdown that you've done for them, what do they do with it then? Is that just they going back to their own regular accountant and saying, here you go, make a claim?
It's a relief that's claimed. It's not a standalone submission for this one. Unlike the Living City initiative that I spoke about earlier, that's a separate relief for those designated zones. But the relief we were talking about, this type of capital allowance is available by claiming it in your tax return. So that tax return is filed and submitted by your tax advisor or your accountant. So the report we prepare gives the figure that they should be claiming, and it backs it up and substantiates it, which is what Revenue will want if they look into it and ask, why are you claiming this relief? Well, here we've got this substantiation provided by a specialist, so it backs that up. So yes, it goes to the accountant and they claim it within the tax return.
Okay. And in your experience, are accountants, when they see this, are they getting on to you and going, what the hell is this? Are they taking you at your word? Or how does, in reality, how does that work on a day-to-day basis?
So I suppose, number one, a lot of our work comes from accountants, because I suppose they would refer us as a specialist to look at this particular area. And look, I think out there's a perception sometimes that the accountant is the go-to person to do absolutely everything, that they should know everything about all areas of tax.
All-knowing.
And honestly, that's unfair on the accountant, really. They can't be expected to know everything about accounting and tax. It's a hugely broad area. And I know people who specialise in so many different areas. So it's not something that you would expect them to be able to dig into the details. So what they will claim is they claim the stuff that you mentioned after the purchase, the kettle, the toaster, the couch, things like that. But when it comes to a property purchase,
they just see the one-off invoice for the property. They don't see the breakdown that you can deliver.
Yeah, and we're not breaking down the purchase. We're making a post-purchase apportionment, really. So, to do it, you need that surveying element, that surveying expertise to back up the claim. I don't want to go into too much technicalities on the process, but there's a detailed process needed. You need to reconstruct the cost of the building. You need to prepare land valuation as part of the process. So look, it's quite a detailed process, and capital allowances anyway is a specialist area. So a lot of accountants that we meet, sometimes, to go back to your original question, they are seeing this for the first time, and we are explaining the process to them. But like once they get it and they realise that this is legislated for and that you're entitled to do it, so they're happy with it then.
Yeah.
So,
and I mean, we'll stick with your example for a moment, although I want to go into the kind of corporate world in a second too. But if we stick with the individual buying the €500,000 property, and first of all, question, how long does it take for you to do your job? And second of all, if you can, and I'm sure it's how long is a piece of string, and you go, no, I can't tell you that, Paul, but in broad terms, even if we look at a heating system being the example you gave, in a £500,000 property, what percentage of that £500,000 would be the heating system?
So, like, these things are all costed by, charter surveyors. So it depends on the size of the building and the type of system. Every case is different. But to kind of answer the question in a different way, out of that £500,000 property purchase, to give you a range of what would qualify in general terms, for residential property, that's a rental property, we see a range of in around 10 to 20% of that purchase price, typically being capital allowable items that you can write off against tax.
So going I'll ski down the mountain, if we're going at the top end of that, 20%. 20% of £500,000 is 100 grand, and 40% of 100 grand is 40 grand. If I'm an individual taxpayer and I use someone like you and identify this, the benefit to me in that example is around €40,000.
Correct, yeah.
Okay, very good.
And like, I suppose that example would be at the low end of the scale. I'd like to give you maybe one or two examples.
Do, please.
So I wrote down the figures here so I'd remember. But like one client, he had a 1.2 million purchase of 3 rental properties. And what he did in this case was he did get a surveyor involved to look at the capital allowances for him, but the surveyor was it wasn't a specialist in the area, and I suppose didn't really know what he was doing to a degree. He had an idea, but anyway, he identified 78,000 of capital allowances. On
the 1.2?
Yes. So we were asked sort of what we thought of that and had a look at what was done. And look, the claim that was prepared wasn't done in a tax compliant way, number one. And there were some items in there that shouldn't have been claimed. But there was a huge volume that hadn't been considered at all. So we reanalysed that. We uplifted that claim by 265%. We identified an additional 130,000 of capital allowances, but more importantly as well, it was a more robust and more compliant claim that the taxpayer wouldn't get in trouble.
Yeah.
So, like, if the taxpayer had submitted the 78,000 claim, Revenue aren't going to come back and say, no, you've underclaimed, you should be claiming more. They're going to say, why have you claimed 20,000 here? That's not compliant.
Which is not allowable, yeah.
So it doesn't matter that they underclaimed. When it's done by a specialist, you can get over double the claim, but it's
So in your example, your intervention there gave the customer €52,000 in extra tax relief that he or she wouldn't have had they not used your services.
correct. Yeah.
And I mean, I don't want to ask you how much you earned, Philip, but I do certainly say to people, fees aren't to be avoided. Fees are to be compared to the benefits. I would be right in assuming that the fee was considerably less than €52,000 without asking you how much you earned. That'd be fair, I
We're
presume.
always conscious of our own fees and making sure that the client has value in terms of there's a benefit there. So, we would always look at the tax saving and make sure that our fee would be less than the first year of the tax savings, never mind the rest. So,
right. So in that case, that
varies.
client is ahead year one, albeit maybe slightly because the fee is in that year. But in the following 7 years, it's all profit to them.
Correct, yeah.
Very good, very good.
One more example, if you'd like.
Yeah, please. All the examples you can give us.
So another client, and this is on a bigger scale. So this client, they owned and operated their own family business for a number of years on a site, and it was a retail premises. Without giving away too much, so that the client doesn't get recognised, So, a family-owned business. They'd run it for a number of years, and they ended up spending €15 million redeveloping the entire site. So they extended their retail premises to create a large supermarket, and then they developed apartments and a couple of commercial units as well. And this was, at the time, it was completed in 2022. So the client, they had claimed 900,000 of tax relief through their accountants. So 900,000 out of 15 million.
Not to be sniffed at.
Sounds okay.
Yeah.
That was on capital allowable items, and then also some repairs which are entitled to write off in some cases. So they were almost out of time, and I met the owner at a business meeting, and he got interested in what we do and whether there was anything additional available. So we dug into the detail, analysed the entire 15 million spend, and we identified an extra 2.7 million that he could write off as a capital allowance. So there was a significant chunk that hadn't been considered at all. In fact, none of the items within, we'll say, the building contract works had been looked at all. I suppose if you look at it one way, what tends to happen is, to go back to the accountant's example, what they see is they'll see a building contract. We say if a building contract is 15 million in this case, they'll see a whole host of invoices from a builder. We'll say it could be 900,000 each multiplied by 16, 17, coming to your total of 15 million. They don't necessarily see any detail behind that, but if you have a surveying background, you'll understand there's detailed information to dig into behind that, and that there's significant qualifying spend within that if you can dig into the detail and use expertise to extract the qualifying spend. So that's what we did in that case.
And 2.7 million extra.
And he was going back in time.
He was a happy chap.
He was a happy chap, and he was going back in time as well. He was going back to amend, and he was almost out of time.
The 4 year.
To get the whole lot.
Right.
So he got a significant tax refund out of that one.
Wow. Okay. Very good. And you mentioned expertise there, and if I'm reading or hearing you correctly, there's two you embody two pieces of expertise here. One is the surveyor expertise, which allows you to do what you've just said you can do. You can look at a 900,000 invoice and break it down into its component parts. And then you have the tax expertise. So this is a real symbiotic relationship here, isn't it? And one would be, where a tax and surveyor in one is more than a tax and surveyor if they're doing this independently of each other.
Correct. And look, you do see accountants who maybe appoint a surveyor to look at building works and claim this relief. And that's what happened in my earlier example with the 260% uplift that we found. But there's in that case, there tends to be no real control over the process. Who's leading it? Is the accountant or is it the surveyor? One is relying on the other. And the accountant won't get the intricacies of the capital allowances in enough detail to be able to
challenge,
tell whether is it right or is it too low, is it too high? And the surveyor can't be expected to have the tax knowledge to be able to get it right or to understand the tax law enough to know, am I claiming everything here?
Yes.
Are all these items actually allowable, or is there some...
But even in your example, the surveyor had identified items that weren't allowable.
Exactly, yeah.
Because in that case, he or she lacked the tax knowledge, and the accountant had missed things because he or she lacked the surveyor knowledge, even though both thought the other was covering the area of expertise that they didn't have themselves.
That's what we see anyway, yeah.
Yeah. Oh, okay. So specialist advice here. I mean, I often say to people in terms of what I do is, consider me a financial GP. And what I mean by that is, you go to your GP's office or a surgery, they can generally help you with 85 to 90% of what you present to them. Take these tablets for 2 weeks, don't drink alcohol, you'll be fine. Get up early, you lazy bugger, and have a walk on the beach, you'll be fine. But if you go into that GP practice with a pain in your chest, they don't take out a scalpel and open you up. This is where a specialist is needed. This is where, in my example or analogy, the cardiologist is needed. So the skill is recognizing, isn't it, when the specialist is needed. So how do you go about, you mentioned a while ago that many of your clients come at you through accountancy firms. How do you go about getting the rest of them? How do you promote yourself? Obviously today we hope lots of people are hearing you for the first time. But without this, how do you go about getting the people and finding the people you can help?
So typically, the types of people who we help are, we work a lot for property investors. We also help people in the hospitality sector, so pub owners, restaurateurs who are fitting out premises or purchasing premises, medical sectors as well, so doctors, dental surgeries, things like that are being fitted out. We look at those.
It's word of mouth, I suppose. Then a lot of ways. You help one person who tells another person.
Exactly, yeah. And we would do CPD for accountants in that way, so that the message filters down to accountants that this relief is there and that there's specialism. So
CPD, continuous professional development. Are you doing lectures then in this field?
We would do CPD on behalf of all of the main accountants' bodies.
Very
Irish
good.
Tax Institute as well would bring us in to speak to their members. So that, and we would network with property investors as well. But look, at the broadest concept, my background is that I would have worked for two of the big four accounting firms specialising in this area. And I would have started off with one in Dublin many, many years ago, 20 years ago now. And I suppose I saw that they were offering this service to the huge corporates.
Yes.
And not really anybody else weren't
getting the
interested
benefit.
in doing it for somebody spending 10, 20, 30, 40 million or less.
Yeah.
So I saw there was a huge gap in the market for opening this offering out to the large businesses and to small and medium as well. So I went to the UK for a number of years, and there's it's a bigger industry over there in terms of specialists who do what I do. So I learned a trade after working in Dublin in this area for a while. Went to the UK for a number of years, learned how they did it. Took all of the best bits that they provide there, took it back to Ireland, and in my last role I was heading up the capital allowances team for one of the big four, and I just said, I want to get out of this and just open the service offering up to everybody. And so that's what I did, set up CA Partners.
Very good. You remind me of Steve Jobs famously said, I didn't invent anything, I just perfected it. But I mean, you also remind me of something that is very close to my heart and why we exist at all, which is, and I was saying this to you before we started to record, you know, that Mr. Average on the street is well catered for by the high street financial advice system. The super rich are well catered for by international big four tax consultancies charging them huge fees, and they're living in Switzerland or whatever they're doing. But that there's a whole cohort of people in the middle that are too rich to be well catered for by the generic. So I can see that in what you've been saying, the generic capital allowances claim from the standard accountant. Too poor to have the international consultancies having them living in Switzerland. And then falling in the middle and not claiming because, as you say, the knowledge isn't available. So it sounds to me like your business and my business are aimed at pretty much the same cohort of people, and that you're bringing big four knowledge to the SME and individual investor market.
That pretty much sums it up. Yeah, no, I can see the parallels there for sure.
Well, I'm delighted you're doing that, and thank you on my behalf and on everybody listening behalf. I just wanted to ask you about what the role the revenue play in this whole process. From listening to what you've been saying, you're basically producing a set of data that allows somebody to claim their rightful allowances. How and the revenue have to kind of box tick that data, if you like. How often do the revenue buck against this type of claim, if at all?
Yeah, so we see inquiries into maybe 5 to 10% of the claims that we prepare, and they can range from anything from revenue might just ask the question, why are you claiming this level of capital allowances? And the default answer is a specialist.
Because it's the law.
Well, but you need substantiation.
Yeah.
So they might just ask like a question like that, and I suppose if they see a spike, we'll say a huge claim one year when the previous year there was only a small claim. They might ask a question, and the question or the answer would be a specialist capital allowances report has been prepared to substantiate the claim. Let us know if you want to see a copy.
Yeah.
That's the sort of the layman's term of how you navigate that. And sometimes that's the end of it. And sometimes they might ask for the report. And sometimes that's the end of it. Sometimes they can ask a few questions about it. That could be the end of it. Sometimes, depending on the inspector you get, they can go into any level of detail. So it could be from the very simplest interaction to going to town on every item that's claimed. To be able to back it up, you need to understand the case law, be able to quote the case law back to revenue as to why a certain item qualifies as a capital allowance. And if you don't have that, they just say, prove it or lose it. Like you cannot claim it unless you can prove. So that's
and I suppose, does that mean part of the service you provide is that not only are you doing the kind of pre-revenue work, but if I've paid you a fee and I've got your report and it's itemised these allowable, what you say are allowable deductions. And I put that into revenue and they either disagree or argue back or ask questions. Am I, as your client, am I coming back to you saying, now, Philip, they've come back? Is that part of the service you provide?
Yeah, well, and it's in our interest because every interaction we have with revenue, we want to protect our own reputation as expert advisors and people that, like, we're trying to optimize this relief for our clients, but at the same time, we want to make sure it's compliant and that we're not overstepping the mark and doing anything aggressive that's not in the client's interest and it's not in our interest, because if you do it incorrectly once, revenue have your card marked and your brand gets spread very quickly through revenue. I could tell you horror stories about how revenue work in terms of branding particular advisors, and any interaction with them, they look at it a lot more closely when you do that once. So it's in our interest.
You're under the microscope.
Exactly.
Yeah.
So we do help to navigate those questions if they come.
I'm not sure you'll be able to answer this question, but it comes to me as you're talking there. I mean, as I told you, in terms of my business, I come across people every day, every single day, that are missing claiming allowances that they should be claiming. Whether that's simple allowances like I talk about SBE or subsistence allowances or, EV car write-offs and all that sort of stuff. And by the sounds of it, you come across people every day who are missing allowances in your more specialised world. In the world of property and property investment and property purchasing, would you have any idea of what percentage of people who are buying property, no matter how they're doing it, individually, corporately, in partnerships, that you think might be missing at least some allowances?
Most people who it depends on the profile of the client and the level of spend, but in the sub 10 million space, 10 million outlay, most people are not claiming this tax relief at all.
Okay.
I couldn't put a percentage on it, but every
well,
client.
I suppose 100% of your clients aren't.
Exactly.
So that's your experience. But I have to say, without having any statistics at my side here, I have to say, listening to you and listening to the allowances that are available, I would think most people, I would be surprised if 90% of property owners in that, beneath the 10 million, as you say, bracket, who are listening to this, it wouldn't surprise me at all if 90% plus of them weren't claiming the allowances they're entitled to, and haven't, I suppose, more importantly for those who've missed the boat, haven't claimed those allowances since 2021, and therefore have the opportunity to go backwards, which is very good news, and delighted to hear that. Well, Philip, it only remains for me to thank you again and just ask you, if listeners did want to talk to you and have a preliminary engagement to see have they missed the boat, how do people get in touch with you and your business?
Yeah, so look, we're happy to have an initial chat with people if they want to explore their own situation, if they've spent money on property. So they can get in touch with us either through LinkedIn is probably the easiest way. Search for CA Partners or my own name, Philip O'Connor. And then through our websites, capartners.ie, so that's capartners.ie.
Okay, great. Well, look, as I said, it only remains for me to thank you for your time today. Thank you for your expertise. Every day is a learning day. I've learned something new here today, and I hope our listeners have learned something new. And for that, we're all grateful. Thanks, Philip.
Thank you, Paul.